Over the last several years, Jonathan and I have pretty much ragged on syndicators. We ragged on them for paying too much, for having bad assumptions, and for creating structures where LPs would lose money. Jonathan and I both believe that the opportunities coming in the space will be big as the folks who did bad deals last time get wrecked, which provides opportunity. So I thought we should step back and really ask a question. How do syndicators make money? How do the big names rip you off? The bigger the name, the bigger the fees. So let's talk with Jonathan Twombly about how the heck syndicators make money and how you can protect yourself from somebody that's out to take your money. Jonathan, how you doing?
I'm doing great, Michael. So yeah, I put this together for my own coaching group because I wanted to kind of show them how in a syndication business, you can relatively quickly get to $100,000 annual income. And it is a great business. And I think for people who do it right, they're providing a great service. But I thought it would be interesting for people to see kind of how you make money. And I want to just point out before we get into this, that this is actually does not include like your back end participation in the sale. This is only about the fees that you would charge on an ongoing basis. And I'll also just mention as well, I personally only charge a couple of fees, right? I only charge an acquisition fee and an asset management fee. There are people who charge all kinds of other fees like loan signing fees and disposition fees and refinance fees. And like, there's a whole bunch of different fees that you could charge, but I like to keep it simple and keep it, relatively low cost. So with that said, I put together the spreadsheet, and I don't know, Michael, if you are able to share it.
Yep,
so, okay.
There you go.
All right, cool. So now this is just, like I said, real simple, but the point is to show you really simply how syndicators make money and how quickly you can get to 100,000 in syndication.
Okay.
So the first thing I want to point out is that you'll see here, right, there's an acquisition fee, which I have set at 2% of the purchase price.
Okay.
There is a capital raise fee, which is set at 3% of the capital raised. And this is not something that, it's not on top of this acquisition fee. This is actually a part of the acquisition fee, but you may be paying this to people who help you raise capital, or if a fund of funds is investing with you, you may waive this portion of the fee so that they can charge it to their investors and there's not a double fee, right?
Got it. Mm-hmm.
So this is not an additional fee. This is an additional fee, the asset management fee, and this is an annual fee. And what I do is I charge annually 1% of the amount of capital that was raised. And this is basically, the reason for this is because you have to get paid for the work that you're doing, right? Mm-hmm. This acquisition fee compensates you for all the work that you did to get the deal closed, which usually involves you putting up your own money as earnest money, putting money at risk, things like that. So plus all the work. I mean, it can take months to get these deals closed. So you get paid when the deal closes. It's kind of almost like a brokerage fee, right? That a broker would get.
Well, the other thing about that fee, again, I've never done these, but when I look at that fee, it's also getting you payment for all the deals you evaluated that you didn't do.
Exactly. Yes, exactly. All the stuff that you weed out that you didn't bring to investors, and sometimes even stuff that you spent money on and then canceled, right? So you may have pursuit costs on deals that you ultimately decide not to do, and or even deals that you started to syndicate and then in due diligence you canceled and you're out a lot of upfront cost, even if you get your deposit back. So that compensates you for all of that, right?
Okay.
So let's just say now let's just say you start out in syndication, right? And you do a relatively small deal for syndication world, which is $2.5 million deal. Okay. So here we go. There's $2.5 million deal. You're going to need about 30% of that in cash. Let's just assume that 25% goes to the down payment and then another 5% covers all of the costs that are associated with the transaction, right? So now you've got a 2% acquisition fee, right, which is $50,000, and then a 3% capital raise fee, so 3% of this capital raise number, right?
Got it.
Now, what this number means, now let's just assume this 3%, right? That you as the sponsor, i.e. me, right? Let's just say that you did not raise a dime of the money that went into the deal. Like you have no ability to raise money, but you have friends who do, or you were able to work with capital raisers or a fund of funds and they raised 100% of the money. So all you did was find the deal, arrange for the financing, kind of set everything up, and you didn't raise any money, which is a totally viable way to kind of run the business. This is what you would wind up collecting from the acquisition fee, right? So of the acquisition fee, you would pay this amount based on the capital raise to your capital raisers, and then you're left with this. And then this is your annual management fee, right? That you're collecting each year on one deal. So let's just go down here and let's just say, what if that's the only deal you ever did, right? So you would make, in your first year, you'd make 27.5, right? And then every year after that, and you could potentially collect this fee in the first year as well, but I have it set up so that you're collecting it. You've already gotten paid this year with this acquisition fee. You start collecting it next year, but there's nothing wrong with collecting it year one, right? But so you've, basically after 5 years, you assume you sell the deal, and let's say, assume you sell it and you just get the investor's money back and that's it. So there's no upside participation. You would wound up making almost $60,000 in total from that one deal. Okay.
Got it. That makes sense.
So like I said before, I haven't included like your promoted interest or whatever. We could maybe come back another time and I could include that and show people kind of what that looks like. But I'm just talking about how you make a living doing this on an ongoing basis. Right.
Gotcha.
All right. So now let's imagine you're doing this at a very leisurely pace because you have your W-2 job still, right? And you're doing this kind of like slow and steady, but you, over the course of the next year, you increase your ability to raise money, or you increase your network of capital raisers, and now you can do a $5 million deal the second year, right?
Okay.
So that's a $1.5 million capital raise, right? So, and people may look at this number and think like, wow, that's an awful lot of money, right? But if you think about it this way, you probably right now, I mean, if you are in most professions, doctor, lawyer, CPA, if you have your own business, if you work for a tech firm, whatever, you probably know 10 people who have $50,000 to invest, and you could raise $500,000 easily. And then you just find 2 other people who know 10 people who can invest that much money, and you've raised your money, right? It's a lot easier than people think. So doing a $5 million deal is not, expand your mind. This is something that you could do as long as you understand that you don't have to raise all the money yourself, right?
Yep.
So we go down here again. So your acquisition fee overall is $100,000. You're going to share $45,000 of that with your capital raisers, leaving you with 55. And now you have a $15,000 annual asset management fee that you're collecting to oversee the deal while you're holding it. If you go down here, now you see, look at year 2, right? You've made $62,005 in year 2. And now your annual, oversight fees, and you have to work for this, but this is not like a full-time job, right? You're now up to $22,500, right?
Yep.
So let's go back and do the same thing again. Another year passes. Another year passes. You've slightly raised your ability to raise capital again. You can do a $7.5 million deal this time, right?
Yep.
So again, now you're talking about $2.25 million in the raise, $150 overall for the acquisition fee. Your cut is $82,500, and now you have a $22,500 asset management fee annually. And if you go down to see what your year 3 looks like, well, look, you've now made $100,000 in year 3, and all you've done is 3 deals over 3 years, which is a very slow pace.
Yep. I like it. 1 deal a year. Yep.
1 deal a year, right? This is like 1 rental at a time, but it's
exactly.
It's for multifamily syndication, right? Or whatever you're going to syndicate. You syndicate self-storage, hotels, retail. You can do this with anything. It works for everything, right? So this is a pretty leisurely pace, right, to be proceeding at. And what you're doing during this time is you're really honing your skills and building your network, right? And now let's just take this up to, let's go 10 million for your in deal year 4, right? And you can see that, in the acquisition fee alone, you're at $110,000, right? So look,
Yep.
your annual take home that year is 155. And then let's say you stop here and you never do another deal, right?
Right. Yep.
You're at $75,000 of annual recurring income just from these 4 deals.
Yep. Just to operate 4 units, just to run 4.
Just to run 4 properties, right? Which
Right.
is completely manageable. I mean, this is not a full-time job to asset manage 4 properties, right? So you could continue doing this while you have your W-2, or you could be thinking about where, do one more deal and now you're over $100,000, right? And and so this shows you like what a viable business this is. Now, obviously, at some point, probably after year 5, you're going to sell this deal, right? So obviously, if you never buy another deal, your income is going to start to decrease. But I didn't show you how much money you make, when you sell, which could easily be a couple $100,000, right? So this is a very viable business that doesn't. It's not going to take over your life.
Yeah. Let's talk about an exit, because again, I love all of this up front, and I know we're going to change some fee numbers just to show you the bigger the name, the bigger the fees. But talk about a realistic exit. Let's assume it's that first property. If you want to scroll up again, you raised none of the money, so you paid out, $22,500 to the other folks. You have. I guess at this point you actually have no money in the deal.
Well, I mean, that's the assumption, but I mean, I think most people would want you to have money in the deal, but maybe you've bought, like, depending on how you set up your shares, you bought 1 share for $25,000 or $50,000, right? So it's generally a good idea if you have the capital. And frankly, I have to tell you, the best deal I ever did was when I didn't have any of my own money in, and it's so like, it's just, I would have made so much more. I made a lot of money on that deal, but I would have made so much more if I'd had my own money in. But I didn't have my own money to put into it at the time. So
So let's assume for a minute you have no money in the deal, because I just want to look at what an exit might be. Let's say we were going to exit this property at $4 million.
Okay, that's pretty aggressive. I was going to say, let's just say, let's say we exit at $3 million. So you've got 25% appreciation. Also, this is very conservative, right? But let's just say you're going to exit at $3 million. So we'll just put in $3 million here. Let me get my formatting correct. Okay, so $3 million, right? And then let's say that this is very typical. So the profit is going to be, so your $3 million minus your 2.5 purchase price, right? And again, we know we're not also including any like principal pay down or anything like that. We're going to keep it
quick
easy.
Math. Yeah.
And then typically as a syndicator, your percentage is going to be 30% of the profit, right?
Okay, so 30% of the upside. Okay.
Yeah, and this is assuming like you met your preferred return, there's no arrears, all this kind of stuff. So you're on sale for this property, you're going to collect
150 grand.
150 grand, right?
Okay. Yeah, I didn't know what the exits look like. Okay.
Yeah, so year 5, let's just say you sell, and now you've got 225 because you exited that deal. Right? Now you're giving up, that fee. And then, we can just do this same thing. Let's just say, you exit this one for $6 million, right? And then this one you exit for, call it, say, $9 million. And then this one you exit at $12 million, right? And then we can just, pull this down.
You need one more zero on that last one.
Oh yeah, I do. 12, 0, 0, 0, 0, 0, 0. Okay. And then let's see. So we'll just have to change this formula. Okay. And then let's just look at this, and we'll just see how you made $1.5 million altogether.
Wow.
Just from those, on these assumptions, just from those.
Call it a decade, right? You took 5 years to get in, 5 years to get out. So.
Yep. And so that's not including your fees. So
correct.
And then you can just, if you could, just to get you $100,000, right? We got you to 75 a year on this, not including any exits, right? And this is never doing another deal again, but and not selling, obviously. But if you just increase these numbers by a little bit, let's say this is 3, this is 6, this is 8, and this one is 12. It probably gets you 87. Okay, I mean, we can just play with these numbers a little bit. Let's say you get to,
well, let's actually flip the script, because I love this. This is again what a conservative syndicator would make on 4 transactions. Now let's be the dirt bags who fee their LPs to death. What are some of those fees look like, so we could be on the lookout for a grifter?
Okay, well, so we got to probably add a 0 here, because these guys are also going to be doing like these, so it's much bigger
25
deals. So yeah, so we'll start with 25, 30, 40, and 50. Okay. So you can see the fees even at this levels are huge, right? What they're taking home, right? So I mean, they're going to get $500,000 for one deal, right? And this is assuming that they didn't raise any of the capital themselves, right? So but these fees are low, right? I charge low fees, right? So typically,
so what have you seen? Let's just blow this thing up.
So I've seen up to 4% acquisition fee, and then I mean, people don't usually push it beyond 2% for asset management fees.
But let's add in all the extra fees, because you were talking about. So these are just
God, okay, that's going to involve all these extra cells. So
well, let's just add them to either of those 2 columns.
Okay,
just instead of 4%, it's whatever.
Sorry, we have to change these numbers quite a bit. So hold on, let's just do this. Fix this. So this is 30, 0, 0, 0, 0, 0, 0, 0, 60, 0, 0, 0, 0, 0, 0. What did we say here? Oh, sorry, not 60. To make like 30. What would be
40?
40, yeah, 40, 0, 0, 0, 0, 0, 0. Call this one 50. 0, 0, 0, 0, 0, 0, and this one 60, 0, 0, 0, 0, 0, 0. Okay, and you can just see, like, they're making $10 million, right?
None of your own money. You made $10 million.
Yeah. Now, to be fair, if they're doing deals this big, they probably have a bigger team. It's not just them. But
of course,
nevertheless, they're doing.
So you can afford a lot of overhead at $10 million.
Oh yeah, and look at the annual fees. Like, you're basically year 5, you're looking at almost $1 million in fees on 4 deals.
Yeah,
right.
That's wild.
So it's just pretty.
And again, these are fees. These are the conservative fees. We haven't even hit.
Well, these are the crazy fees.
Oh, these are the crazy.
Oh, well, we just didn't add in all the other fees that you might get.
Yeah, there's more.
Right?
There's more cash out there for. Yeah. I've seen them. There's more than this.
So, for example, I mean, we could. Let's see where we would put this. So let's say, I mean, it's going to be hard to change this, but
all the fees are either going to be on the raise or the purchase. So we'll just increase the 2 or the 4. That's all we have to do.
Right. Okay. All right. Let's do that. So let's just say that you are in addition to the acquisition fee. Now, sometimes what will happen in a deal, and this is legitimate, if you have some outsider who has to provide the balance sheet for you because you don't have a net worth of
you're gonna have somebody
$25 million. Well, you will pay them like a 1% fee, right? Now, if you're up there at 4% and you're not just reducing your fee to like 2 or 3% and giving them 1, like, that's crazy. But let's just say, okay, but what I've seen is people now, they're already getting the acquisition fee, but then they're charging a separate fee for themselves to sign on the note, right? Which is, to my mind, well, if you're always signing on the guarantees, and part of what the acquisition fee is also compensating you for that. You'll get to charge again. Like, you could pay somebody else and it's fine, and maybe even tack it onto your fee. That's fine. But like, to then say, oh, well, I'm also signing some, also going to charge a fee. Mm-hmm. It's like, okay, come on. So, but I've seen it done. So let's raise this to 5%, right?
Yep.
And I mean, now you're talking about just, look, you're making $1 million just in fees from one deal, year 1, right? Yeah. You've made almost $6 million just in acquisition fees and loan guarantee fees. At this level.
That's before you exit. That's on the front end.
Yeah, that's on the front end. right? And you can understand why people get upset, right?
Yes,
And
no kidding.
yeah. So
Oh man,
it's just,
now, one quick question. I'm sorry. You get that day of closing.
yes. Yeah.
Day of closing, you made $6 million
Day of closing made
without any performance, without any returns, without.
Yeah, I mean
else.
over 4 years, right?
Yeah.
But day of closing, like your first deal.
Yep.
Now listen, you're not going to do your first deal for $25 million. I can't. I mean, this drives me nuts. I have people who will basically like come in, either approach me somewhere or come into my Facebook group, and they see what all these people who have been doing this for years are doing. And they're like, oh yeah, no, my first deal I'm working on, it's like, $50 million deal. And I'm like, you don't even know what you're doing, right? Where's this money going to come from? And how are you going to operate this deal? What do you, and like, but they're very insistent that they're going to, it's like, start small. That $2.5 million deal we started out with is a completely attainable thing for you to do.
I agree.
It's completely attainable. And especially get 2 friends, 3 friends, you could easily do that deal together. And get started. But so anyway, so this is kind of how syndicators get a bad name, right? Because, and then you look at this one on the other side. Let's say that you're collecting your 30% promote, right? But let's say you're also collecting a disposition fee, right? Which I've seen people do on top of the promote that they're charging.
So they get paid to buy it and they get paid to sell it.
but not only that, but they're getting this 1.5 million here when they sell, right? But then they're also charging you for like the work of selling it.
Yeah.
Right.
To go to the closing table again and sign your name.
Yeah. So let's just see how this, and they're charging it, I believe, not on the profit, but on the entire. Like
I'm sure it's on the sale.
Right?
Yeah, of course it is.
So let's see how this looks.
Oh, this is gonna be ugly.
I'm gonna do this. Okay. So they're getting another $300,000 just for not doing any additional work, but they're just,
they get paid to list and sell the property.
they get paid to talk to a broker about selling the property, right? So let's just take this down, right? So then we'll sum this up, and you'll just see, and this is where it just gets abusive, right? Because people are another 1.8 million just because they can. And when you're dealing with the really big name groups who have like armies of capital raisers and are closing deal after deal after deal, and they're kind of, their whole business model is creating fear of missing out. Like this is what they're doing. And
so let's add this total. So we have 10.5, 1/8. So that's 12.3.
Yeah.
12.3. And then what are all the other ones?
So there's 12.3.
$20 million.
Yeah. Plus these 2, right? Because this is the sum of the, so plus this, right? So $20 million on 4 deals, right?
Folks, if you have a syndicator that's charging you all these extra fees, be careful. The bigger the name, the bigger the fees.
Yeah. And listen, where are the fees coming from? They're coming out of your return, right? And they're counting on people who are like, not really understanding the economics of this, and satisfied with, you're going to pay me 8% return. Like I'm really happy with that. And not really, realizing how much.
Let's see if we can.
Oh, can I just do one more thing? Let's do the 60-40 split.
Oh, geez.
Yeah.
Oh no.
And then, then you just see how this just gets like crazy.
Right? $22 million. Well, let's talk about being an LP in one of these deals. So we know what the syndicator is going to make with all these extra fees. Let's just be hyper conservative. Say they met their return fees. What would the LPs? Again, we have to make wild assumptions, but
okay. Well, let's just make it really easy. Let's just imagine there's an 8% preferred return.
Perfect.
That got met every year.
Yes.
But it didn't make any more money. Like it didn't.
Yes.
It wasn't a screaming deal that was making 12%. It just made your 8 every year.
Yeah. Made the hurdle rate. Yep.
Made the hurdle rate, and then you get your 70%. So let's just go here. Let's just say, okay. So preferred return. Let's just assume that this was 8%. Okay. Then So, okay, for deal one, so it's a 1.25, right? So this is going to be this times,
Yep.
let's see, times this times 5. Okay, so you've made 500,000. I mean, all the investors together.
All the LPs. Yeah.
Yeah, have made 500,000 on the, and then obviously they get their money back, and then they're going to make 70% of the upside, right?
Of the
So
1.5. Yeah.
of the 1.5. So 7. Okay, percentage equals this times this.
Nope.
So,
The profit. No. The profit's 1.5.
oh, no. They're making, because.
Oh,
sorry.
no, that's the 5 million. Yeah. That's the profit. Okay, got it.
If somebody could tell me how to not have this happen to my spreadsheets when I move around all the time, I'd be so excited. But okay. So they've made, so basically,
so the LPs made $4 million over 5 years in this example.
Yeah. So let's just total that up. Oops. Okay. So they've made $4 million, which their total return is 4 divided by the 7.5. So they made a 50% return, right, over, call it 5 years, so 10% a year, right, on this assumption.
Yeah, very conservative.
Yeah.
So again, all the money, all the equity made $4 million, and if we just look at the first deal, the general partner who had no money in the deal is probably at $2 million, because again, they're going to get the yearly fees as well.
Yeah. So yeah, exactly. I mean, it should be like, so when I actually have, like, when I do my underwriting, I have a calculation of what percentage of the money am I going to get of all the profit of the deal. And it works out to be about usually somewhere in the range, because we're doing a 30% split at the back end. Yeah. So it'll wind up being a little below 30%, right? Which I think is fair. But this is not, when you've got all these fees in here and stuff,
all the extras. Yeah.
You're going to get,
it can very quickly go 60-40 instead of 70-30.
Yeah. So, and 50% over 5 years. I mean, it's not
horrible.
It's not horrible.
That's mailbox money. That's truly passive.
Yeah. It's passive. Yeah. I mean, solely passive. 10% a year is not bad, but honestly, these deals should be returning more, So.
Yeah. What would, so let's call 10% just a single. What would a double or a triple?
Yeah. Well, because I mean, so your property appreciation is only 25% over 5 years in this scenario. So that's pretty low,
Yeah. So let's play this out. So let's assume they bought a value. Let's say they didn't buy, I don't know, value add or whatever. Let's say they got a screaming deal because they found that one motivated seller that needed to get out by the end of the year. So yeah, they bought it for 25, but it was worth 35 the day they bought it.
Yeah.
Then they operated it well. You had some increase. So instead, let's say the exit's 50 million.
Yeah. I mean, even that's a little aggressive, I think, but I think what you should, let's just say that, like, you really should, without too much effort over a 5-year hold, be able to, like, kind of double the equity, right, on the sale.
Okay.
Right. So that
would be 40 in this example, if I understand.
Well, no. So the capital raise is 75.
But you said you doubled that.
Yeah, double this. So that would be, so you'd be, because it's included in the 25. No.
Oh, it's in the 20. So
yeah,
so it's 32.5.
It's 32.5.
Okay, got it. Oh, it's already in there. Got it.
Yeah.
Okay. All right.
So in that case, you're up to a 77% return. So you almost doubled your money, right?
Yeah.
So that's,
that's not horrible.
Divide by 5. That's 15% a year.
Yeah. Now you're talking.
Yeah. This is kind of more typical, right, what you're going to see. So, and a good deal will be, 20% over the 5 years. So
a year, 20%
a year. Yeah.
For 5 years.
Yeah.
Got it. Okay. All right. That makes sense. So again, when we start evaluating deals in the future, LPs should look at the fee structure. They should look at any kind of extra fees, exit fees, disposition fees. These are all signs that you are being potentially taken advantage of.
Yeah. And, a lot of, I mean, the more sophisticated the investor, the more they're going to push back on the fees, right?
Sure.
What a lot of the syndicators are counting on, like during the bubble, they were able to make really fantastic returns for their investors. So they're making them, 30, 40% a year. So who's going to complain about high fees when that happens?
Sure.
But the problem is, more sophisticated investor will say, yeah, but that's my money. Like you made me 40, but I should have got 50% on my money. Right.
Yeah.
If you went to like, a family office or a really sophisticated high net worth investor, like they're going to look at these fees and be like, no way, I'm not paying that. But so they sort of are counting on people who are just going to be dazzled by like the 40% return and not think about the equities involved. And also the response, if people raise objections, is like, are you complaining about 40%? Like, take it or leave it. You're going to get 40%. Do you want it or not?
Yeah, the big capital raisers have an army of folks, and all money is green. They don't need your green money. They'll just go to somebody else if you want to be a problem. Yeah.
So the thing is, just watch out for this. The other thing I would say is, if you're looking at, now this is just this 15% return number. I would say this is pretty average for like your kind of like B class light value add type deal over a 5-year hold. If you see numbers either significantly higher or significantly lower than this, you should be asking questions. Now, if it's lower, it could be lower if this is like a brand new build class A where all the tenants are like investment bankers and they're paying their rent like on auto deduction, and they don't even notice that it's gone. Right. And they might even forget to turn it off when they leave. Right. Cause it just doesn't even matter to them. Right. Yeah. So that's like, if it's that kind of deal, then maybe like a 10 or 12% annual return over 5 years is fine because it's super low risk. On the other hand, if it's a really, really deep value add deal, that should be higher. But I always people should be wary when if it's too good to be true, it may well be, right? So, and we have this happen. I mean, I talk about this with my syndicator friends all the time, where it's very frustrating, where you're talking to an investor about doing your deal and you've underwritten it really conservatively. And the guy's like, oh yeah, I invested in this other deal because they promised a higher return.
Yeah.
And it's like,
come on, guys.
Yeah. Okay. Well, maybe they'll get that, but do you understand, is there a risk differential? You just can't say, oh, this one promises 15, this one promises 20. So the one that's promising 20 is better. The one that's promising 20 is likely riskier. And you have to understand that the risk reward differential. Yeah. So anyway,
love this. Well, you have a school community. Again, if you wanted to get involved with this and be a part of these conversations, they just go to school.com/AIC. Is that right?
That's right. And you will learn exactly how to do this if you go to my school group. Now, I do want to mention that I'm about to restructure my school group to be smaller and more expensive. I mean, I'm going to be involved a lot more personally. It's going to be a lot more one-on-one stuff. But I will grandfather anybody in who joins now. So if you want to get in before that happens and just enjoy the benefits of a lot of this, not the one-on-one piece, but the additional interaction and everything, now's the time to join. This is going to happen next month. I'm restructuring. So time is limited to get in at the current price.
Awesome, Jonathan. You're amazing. Thank you for being here every week. Thank you for sharing with us. Again, folks, school.com/AIC. Take care.
Thanks.